Howard Marks is almost certainly a better investor than you or I can ever hope to be. He's an exceptionally insightful thinker, and when he speaks, we should all listen.
I say, anybody listen to Howard this morning?
The market is betting big that interest rates can fall as earning growth zooms higher, but the Wall Street titan Howard Marks says a return to easy money is no sure thing. And if you follow Howard Marks' writings or interviews he's given, this won't be news to you. This is consistent with much of his post-pandemic writings and thoughts.
I have heard him say that.
So don't worry about the rather indifferent start to the year on global markets. Investors appear to have lost little of the bullishness that helped spark the extraordinary rally we saw towards the end of 2023. According to US research firm Consensus Inc., which conducts weekly surveys of future market newsletters and brokerages reports that aggregate the percentage that is bullish, share market movers and shakers haven't been this bullish since 2018, well before COVID hit, well before the crazy COVID rallies. We're going back a solid 6 years before we saw that sort of data.
Has it been that long?
Take that with a grainful of salt. I mean, it's survey data. Don't get too excited.
Not super exciting.
No.
However, there are a lot of things that people are looking towards this year globally that may be moving equity markets. We have an unusual amount of geopolitical risk as well as a considerable amount of democratic activity, and those elections actually represent an astonishing 80% of the world's market capitalization. On Friday night, JP Morgan produced the biggest annual profit in US banking history.
Shares of JP Morgan Chase up 14 points!
Before belief in the idea of immaculate disinflation was boosted by a softer producer price index in the US on Friday night. And most importantly, money markets are now ascribing an 80% chance that the US Federal Reserve will cut rates in March, with as many as 7 rate cuts to follow during the year.
Well, that's great news.
That will be, of course, a huge upswing. The Wall Street titan Howard Marks, however, the co-founder of Oaktree Capital, says in his latest memo that the market's Goldilocks scenario remains intact.
Oh yeah, that's a relief.
That inflation is moving in the right direction and will soon be within sight of the Fed's self-declared 2% target. Further rate increases won't be necessary, which means we'd be getting a soft landing with a minor recession or maybe none at all.
I need something soft to land on.
This would allow the Fed to start cutting rates, which of course would be good for the economy and markets.
It'll be good for the economy.
It's a bet, says Howard Marks, that the economy won't be hot enough to raise inflation or cold enough to bring an economic slowdown. But Marks remains wary. Well, according to him, he's seen the Goldilocks thinking into play a few times over the course of his career.
This isn't my first rodeo.
And it's rarely something that he says has held for long. Something usually fails to operate as hope, or something unforeseen might occur, and the economy move away from the perfection that people were hoping for.
It's the economy, stupid. Okay?
Of course, easy money expectations are what some people desperately want to return to.
Yes, the money is good.
That's something that looks pretty obvious given US investors are banking on earnings growth of 12% in 2024, which of course is a large amount. But if the global economy is strong enough to support that level of earnings growth, will the predicted rate cuts arrive as soon as the market predicts, and in the magnitude that investors clearly seem to be hoping for?
We want more money.
Well, one important effect of the Goldilocks thinking here is that it creates high expectations among investors, and thus there's room for potential disappointment and, of course, losses for those who are actually speculating. Mark says, right now, the expectation is centered on one of hope, the rapid return to an environment of easy money.
Easy money.
The sort of environment we saw certainly before COVID and realistically since Obama's presidency started. Like most investors over the past 2 decades, Marks has put a lot of thought into the impacts of low interest rates, and a new book by financial historian Edward Chancellor called The Price of Time led him to pen another memo on the phenomenon, which is, as he says, a multifaceted and ubiquitous yet frequently overlooked phenomenon. Obviously, easy money makes things easier.
Man's a genius.
Easier for central banks to stimulate the economy, easier for finance deals to get across the table, easier to run businesses thanks to cheaper finance, easier for investors to ignore opportunity costs, and easier to enjoy rising asset prices. But easy money, both Marks and Chancellor argue, invariably sows the seeds for the next crisis by encouraging what the economist Friedrich Hayek called malinvestment. Or, as Marks explains it, in low return times, investments are made that shouldn't be made. Buildings are built that shouldn't be built, and risks are born that shouldn't be born. Chancellor's book points out how this cycle has played out time and time again.
You've seen it before, haven't you?
Of course, history doesn't repeat, but it rhymes, and there are cycles we've seen before in play here again. While high interest rates have brought moments of crisis recently, of course, we can all remember the collapse of Silicon Valley Bank and FTX, as well as some other examples from the past 12 months, any drama has proven to be fairly benign. Given how long of a period we enjoyed of easy money since the GFC and the beginning of Barack Obama's presidency, it's hard but to help wonder whether the malinvestments made during the long period of excess capital could really have been cleaned out by higher rates that we've seen in only 2 years. Which means we could make, if we were so daring, a bold prediction. While all investors are cheering for the prospect of return to easy money, because of course, easy money breeds easy times, while investors in sectors such as venture capital, commercial real estate, and profitless technology companies have extra incentive to see rate cuts begin as soon as possible.
That makes total sense.
And all of that leaves out a key question. Is easy money coming back?
That would be great.
Great.
Although Mark points out that rates remain historically low, he argues that interest rates are more likely to sit between 2 and 4% over the next 5 to 10 years, and specifically around 3% or 3.5%, rather than the 0 to 2% we saw after the GFC. And that's probably a better place for us to be from an economic point of view. Modern monetary theory is certainly more comfortable in that slightly higher range. But why does Howard Marks think this? Well, first, he says that inflation is likely to remain higher as globalization declines and the bargaining power of labor increases. Second, and perhaps most importantly, he argues the Fed will want to give itself room to cut rates again if the economy falls into recession. Remember that central banks around the world are able to cut rates in part with a view to actually stimulating the economy when it starts to slow down. If they cut rates too low in the first place, they really do minimize the ability for themselves to go and cut them again. Hence why they're unlikely to want to go below 2%. Now, it's a bold prediction. There are other issues to consider here too, particularly given that this is only 12 months we're speaking of. There's no need for them to go down so quickly. And there are a lot of broader things to be considered as well, like whether the extraordinary easing of financial conditions in the last 2 months of 2023 will spark a period of stronger economic growth and inflationary pressure. Who knows? But we will see, and we'll probably see some better data between now and March, and certainly we'll see better data before any further contemplated rate cuts after March. But whether Marx's rate prediction is right or not, it's not really the point. The question for bullish markets, which are seemingly trading as though we're heading back to zero rates or something close to, is whether their belief in return of easy money should be as strong as it appears to be by the rally towards the end of last year. I would suspect that it shouldn't be. Anyway, that's just my thoughts. I am more than happy to hear your disagreements in the comments below.
One more take. Please stop saying don't forget to like and subscribe.
Sure, but how are we going to get followers on this thing then?